Okay, let's unpack this. When you reach into your wallet, whether you pull out a gold card, a platinum card, or a simple Visa, you're holding a piece of plastic money. But functionally, mathematically, and historically, those cards fall into two fundamentally different categories. And understanding that difference is, well, it's really the foundation of modern financial literacy.
It is, absolutely. For the curious learner, knowing the difference isn't just, financial trivia. It's key to understanding two entirely separate financial ecosystems. These systems are built on different revenue models and governed by different, often very obscure rules.
Our mission today is to go far beyond the surface. This is for you, the listener who wants to master the fine print. We're looking at the true mechanics of credit. We'll examine the core difference between charge cards and traditional credit cards, how interest is actually calculated. I mean, we're talking compounding periods and calculation methods that can legally charge you 550% more interest than you expect in a single month.
And we'll also look at how credit limits are set, contrasting the risk-based U.S. model with fixed regulatory caps you see elsewhere in the world. And then we're diving into the surprisingly complex, often controversial world of fees and marketing gimmicks. I mean, everything from historical library fines to the astounding global value of your unspent rewards points.
Our sources give us a fantastic stack of material for this. We've got a historical timeline, detailed mathematical formulas from Regulation Z, U.S. regulation specifics like the Credit Card Act.
Global credit limit data, and even sociological exploration of late fees. So, yeah.
Get ready. Because what you think you know about plastic money is about to get significantly more complex. So let's start with the fundamental operational question. If both cards allow me to purchase an item, what defines them differently from a bank's perspective?
The defining characteristic really boils down to one word.
And that is
revolving. A traditional credit card is a revolving credit instrument. The legal mechanism, it allows you to defer payment.
Okay, so that means you don't have to pay the entire debt in full every month. You just have to hit that minimum payment.
Exactly. You can carry a balance over, and on that carried balance, the issuer charges you interest.
So the bank is in the business of lending money that you slowly repay, often over years.
Precisely. Now contrast that with the charge card. A charge card is also a type of credit card, but it is not revolving.
Not revolving.
The cardholder has a strict contractual obligation to repay the entire debt in full, every single month, by the due date.
And if you don't?
Well, if you fail to do so, you immediately face pretty severe consequences.
Right.
We're talking late fees and typically immediate restrictions on using the card further until that full balance is cleared. It's a hard stop.
That structural difference, revolve versus pay in full, that must fundamentally dictate the issuer's business model. I mean, if a charge card issuer isn't making money on interest from balances, where does their multi-billion-dollar profit come from?
That is the critical insight. Charge card issuers do not rely on interest payments from you, the cardholder. Their primary revenue stream comes from the merchant fee.
A convenience fee.
Exactly. It's the percentage of the transaction value, usually between, say, 1% and 4%, plus an interchange or a minimum fee.
Yeah.
And that's paid by the store or the business that accepts the card.
So the merchant is paying for guaranteed customer access, immediate payments, security.
And the outsourcing of all payment risk.
Right.
Credit card issuers, on the other hand, they derive their main profit from interest on those revolving balances, and that's supplemented by fees from both the cardholder and the merchant. It's a dual income stream.
So if we look at the core strategy here, the charge card model is fundamentally built on high speed, high volume, and rapid repayment. It's all about generating income through those transactional fees.
Whereas the credit card model, conversely, is built on maximizing the income gained from the slowness of repayment. It relies on that long-term interest on revolving debt.
That's a perfect distillation of the strategic difference. And this difference is reflected immediately in how the limits are managed, right?
Oh, absolutely.
Traditional credit cards have a specified fixed credit limit. You hit that ceiling, you stop spending, or maybe you incur a fee.
Correct. But charge cards are typically marketed with what's known as a no preset spending limit, NPSL.
Which, to the aspirational consumer, screams unlimited spending power. But we know that's not strictly true.
It is intentionally misleading marketing. The NPSL nuance is vital here. It does not mean unlimited spending power. It simply means there is no fixed contractual limit printed on your statement that remains static month after month.
So there's still a limit, it's just invisible. The issuer sets what they call a shadow limit.
That's a great way to put it. A shadow limit that changes dynamically.
How does the bank determine that shadow limit? What are they looking at?
They look at a few things, but primarily your immediate past behavior. how often you charge, the size of your average transactions, the speed and consistency with which you clear the entire, sometimes huge balance. And then they overlay that with overall macroeconomic trends and their own internal risk assessment of your profile.
So that shadow limit could literally change month to month, and I might not even know it.
Often without you even realizing it, yes.
So the bank is essentially managing my spending by reviewing my performance last month. If I had a great month and paid off $50,000, they might let me spend $60,000 this month. But if I struggled to pay that off, the limit suddenly drops back to $40,000.
That's the mechanism. And this leads to a subtle but really significant credit score warning that affects many high net worth charge card holders. See, utilization, the amount of credit you use compared to your limit, it accounts for about 30% of your FICO score.
A huge chunk. The utilization spikes are devastating.
They are.
But if I'm paying in full every month, how could my utilization possibly spike? That doesn't make sense.
Because of how some NPSL issuers report to the credit bureaus. This is the catch. They might report a very low assumed limit, say $5,000, or they report a fluctuating limit. So if you charge $4,000 on your charge card, and the issuer reports a $5,000 assumed limit to Experian or TransUnion.
I'm suddenly at 80% utilization.
Exactly.
Yeah.
Which is a massive red flag that can immediately drag your FICO score down.
Wait a minute. So I'm being a fiscally responsible person, paying tens of thousands of dollars on time every time. But the reporting mechanism of my premium card is effectively penalizing me by artificially spiking my utilization ratio.
That's the unintended consequence. It's a flaw in the system. You have to monitor how your specific issuer reports those large balances to the bureaus, or you could find your score dropping. And that makes it harder to get a mortgage or an auto loan simply because the card that's designed for excellent credit is confusing the scoring models.
That is a level of complexity most people would never even contemplate. So let's go back and look at the history of how this dual system even emerged. It wasn't always plastic and dynamic limits.
Not at all. The origins of the charge account are paper-based. They trace back to 1914 when Western Union opened the first charge accounts using just paper identification.
Wow.
And then, through the 1920s and 30s, department stores followed suit, offering credit, but it was all store-specific. If you wanted to shop at Macy's and Nordstrom, you needed two separate accounts, two separate bills.
The major shift came when someone centralized the whole ecosystem, taking that burden off the merchant.
That innovation belongs to Diners Club, launched in 1950. They initially targeted travel and entertainment, and their first cards were actually paper. Cardboard, really. The genius was the network. They signed agreements with a huge number of restaurants and businesses. For a fee, Diners Club took on the entire cost and risk, setting up accounts, authorization, processing, collections, financing costs, and crucially, the default risk.
That must have been incredibly attractive to merchants who could never afford to run their own credit department. It was essentially an outsourced finance and risk management service.
That's exactly. And the concept really solidified between 1957 and 59 when American Express jumped into the field. By 1959, they issued the first embossed plastic charge cards conforming to the new ISO AEC 7810 standards. And that set the stage for the universal plastic rectangles we all know today.
And today, charge cards are often associated with, prestige and high-spending business use.
They are. They're often held by businesses, corporations, executives, the purchasing cards. The Centurion card and the Coots Silk charge card are two well-known examples that our sources mention, and they're really catering to the highest end of the market.
Now, even with that rigid pay-in-full rule, modern charge cards have found ways to offer exceptions. It seems like they walk right up to the line of revolving credit. How do they do that without becoming standard credit cards?
This is the strategic blurring of lines we call the XPO and sign-in travel feature. Providers like American Express recognize that demanding full payment in 30 days for, say, a very large unexpected expense, sometimes that drives customers away. So they created these flexible options outside the standard mandate.
Give us an example of how that works.
Okay, so the extended payment option, or XPO, allows you to pay for specific purchases over a certain threshold, maybe $200 over time, usually for a fee or a specific interest rate. Similarly, the sign-in travel feature applies specifically to eligible travel expenses.
I see. So it's not for everything.
Right. It allows the charge card to offer limited, tailored revolving flexibility for specific needs. This ensures high-value customers retain the card for its convenience, while the majority of the balance still adheres to that core NPSL pay-in-full model.
It's a mechanism designed to retain high-spending customers by mitigating cash flow risk for them. It just shows that even the most rigid financial instruments have to evolve to meet sophisticated client needs.
If Section 1 was about the mechanism of spending and repayment, Section 2 is about the mechanism of cost when you choose to revolve debt. When we move to traditional credit cards, the central profit engine is interest, and interest is an immediate reflection of risk.
The bank is essentially an insurer against default. The higher the risk the issuer takes on a borrower, the higher the rate they have to charge to account for the, statistically expected percentage of losses and still remain profitable.
Precisely. Card issuers calculate that interest optimally based on the cardholder's assessed credit risk. They draw heavily on National Credit Bureau reports like FICO, and sometimes requiring detailed financial documentation for the very largest lines of credit.
So what's the standard range of rates we see in the U.S. market, and how does that compare to other debt instruments?
Typical U.S. interest rates can range from the low single digits, maybe 7% for a super prime borrower, up to the maximum high-end rate, which is often 36%. And it's important to frame this against secured debt. Our sources, using 2005 data, show that secured loans, like a mortgage or an auto loan, backed by real estate or a vehicle, could run as low as 6 to 12%.
Because there's collateral.
Right. Unsecured revolving credit is inherently riskier for the bank, which is why the cost ceiling is so much higher.
36% sounds astronomical, but I know our sources contain data that completely changes the definition of extreme. Let's look at the global situation.
This is where we see the intense interplay between risk and macroeconomic stability. Let's look at the global case study of Brazil. Interest rates there are historically volatile and aggressive. They often run 50% above the average for most developing countries, which already average rates around 200%.
Wait, 200% is the average for developing countries. That's already beyond anything we see in the US or Europe.
Yes, but the rates get much, much higher. New credit card accounts in Brazil in the mid-2000s, even from major international brands, could face annual interest rates as high as 240%. And by 2016, amidst economic instability, those rates were reaching a staggering 450% per year.
450%. That isn't a debt instrument. That's an immediate financial disaster if you carry a balance. What does that rate imply about that specific market?
It completely redefines the nature of credit. It implies two things. One, the risk of default and currency instability is so high that the bank needs that enormous buffer to cover expected losses and inflation. And two, it forces consumers to treat the card purely as a short-term liquidity device.
Meaning they use it precisely how we just discussed charge cards. They pay it off every 30 days no matter what.
Exactly. These accounts typically have very low limits. We're talking 40 to 400 US dollars. But because they offer a grace period, most consumers use them for convenience, planning to pay in full. If they slip and revolve the debt, the penalty is immediate financial destruction. It's a convenience mechanism with an apocalyptic safety net.
That helps us transition directly to the risk model. Loss rates and credit scores. Lenders use scores to predict behavior, specifically the expected rate of loss from borrowers failing to repay.
This is purely actuarial. Our sources provided fascinating 2004 installment loan data, which gives us a clear statistical snapshot of how risk translates directly into expected costs for the lender.
Let's look at the extremes of that data to make the pricing logic really clear.
Okay, so consider the super prime borrower, someone with a 760-plus FICO score. Their predicted expected annual loss rate for the lender is a tiny 0.2%. The lender is statistically certain this customer will repay.
Just a fraction of a percent. Now compare that with the other end of the spectrum, the high-risk borrower, someone below a 540 score.
For this segment, the expected annual loss rate just skyrockets to 19.1%. Think about that. Almost one-fifth of the money loaned to this group is expected to be unrecoverable, even after factoring in collections efforts.
So 19.1% is simply the statistical cost of doing business with that segment. The bank hasn't even factored in their overhead, their marketing, or their profit margin yet.
Correct. That's the foundation of the lender pricing logic. To set the final quoted interest rate, the lender takes that expected loss rate and adds their desired rate of return. Let's call it X. So the super prime customer might get a 5.2% rate. That's the 0.2% loss plus a 5% profit margin. But the high-risk customer gets a 24.1% rate. That's the 19.1% loss plus that same 5% profit.
So the interest rate isn't punitive in a moral sense. It's a necessary hedge against statistical inevitability.
That's a great way to look at it.
What?
And we have to mention the other critical risk factor that can override a good credit score, and that's the debt-to-income ratio, or DTI. The bank calculates this by taking the borrower's total obligated minimum payments on all their debt mortgage, auto loan, student loans, and dividing that by their income.
Why is that ratio so important, even if I have a 780 FICO score?
Because if that ratio exceeds a certain threshold, our source suggests if minimum payments exceed 20% of income, the applicant is considered higher risk than their credit score alone would suggest.
So even if I've paid perfectly in the past, if too much of my income is already spoken for in mandatory payments, I'm less resilient to a financial shock, a job loss, a medical emergency.
Exactly. The bank sees that fragility, that vulnerability justifies a higher interest rate because the bank is looking at multiple vectors of risk. They're looking at past reliability, which is the score, and current financial resilience, which is the DTI, before they set that final APR.
Now we enter the heart of the mechanics, the section that truly separates the casual user from the master of the fine print. We're talking about the math. Because what the bank quotes you is often not what you pay.
This is the moment we unpack the first major piece of financial jargon, the nominal annual percentage rate, or APR. This is the rate U.S. cards quote, and it is usually compounded daily. But here's the key distinction you need to internalize. The APR is not necessarily the direct interest rate paid over one full year.
Okay, so the actual true one-year cost is called the effective annual rate, or EAR. So what causes that gap between the advertised APR and the actual EAR?
It's the magic of the compounding effect. Interest is constantly being added to the principal balance, and then the next period's interest is calculated on that new, slightly larger principal. The more frequently this happens, the greater the gap between the nominal and effective rates.
So compounding daily silently skims a little extra off the top.
That's the simplest way to think about it. If you want the mathematical detail, the conversion formula is ER equals 1 plus APR over n, all to the power of n minus 1, where n is the number of compounding periods per year.
Okay, let's put that formula into practice with an example.
Take a nominal APR of 12.99%. If that rate were only compounded annually, so n equals 1, the ER would be 12.99%. Simple. If, however, it's compounded monthly, where n is 12, the resulting ER jumps to 13.79%. But because most card issuers compound daily, where n is 365, the ER hits 13.87%. Over an entire year, daily compounding always creates a higher effective rate than monthly compounding.
It's a small difference, but over large balances and long periods, that extra percentage point adds up significantly to the bank's bottom line.
And here's the even deeper wrinkle, what our sources call the billing cycle paradox. While daily compounding is generally more costly over a year, the specific relationship can actually flip during individual billing periods based purely on the calendar.
Wait, you're telling me the length of the month dictates the true cost? February is cheaper than March?
In a way, yes. In a short 28-day cycle, monthly compounding might actually charge you more than daily compounding because the principal adjustment is delayed. But in a longer 31-day cycle, the order reverses. This is why comparing rates across different banks with slightly different billing cycle dates can feel maddeningly complex. The true cost is a sliding scale dictated by the calendar.
That level of variability just reinforces why we need regulatory oversight. And this is where the U.S. legal framework comes in with the Truth in Lending Act, TILA, and Regulation Z.
TILA mandates that the interest calculation method be clearly disclosed. That's why you see the standardized Schumer box on your documentation. The regulation details specific safe harbor methods, and lenders must use one of them or provide a perfectly transparent, reasonable explanation of an alternative.
Transparency, yes, but certainly not simplicity. Let's dive into the 4 principal calculation methods, because this choice of method has a more profound impact on your interest payment than the APR itself.
We must master these 4 definitions.
Okay, start with the most straightforward one, the one the bank suggests is the fairest method.
That would be the average daily balance, or ADB. This method totals the balance you held each day during the billing cycle and divides that sum by the number of days in the cycle. This gives you one average balance, which is then multiplied by the daily rate to determine the interest.
And why is that considered the fairest?
Because it most closely approximates the expected rate. If you pay down your debt halfway through the month, the ADB method reflects that reduction instantly. It charges you interest only on the actual amount of money borrowed and the specific time you borrowed it for.
Okay, that makes perfect sense. Where do the complications begin?
They begin with the less precise methods. The adjusted balance method, for instance, ignores the time value of money completely. It only uses the balance at the end of the billing cycle. So if you make a lot of purchases early in the month but pay them off before the cycle ends, you pay less interest than expected. But if you carry a balance until the last day, you pay more. It's volatile.
And the previous balance method.
That uses the balance at the start of the previous cycle. This method often results in higher interest charges if you made large payments during the month, because it ignores those payments until the next cycle starts. However, our sources do note that any balance carried over more than 2 full cycles is generally charged at the expected rate.
And now, the one that makes everyone nervous, the one that can radically alter your cost of debt. The 2-cycle average daily balance?
This method is, well, it's controversial and highly complex. It calculates interest based on the sum of daily balances from the previous 2 cycles. But interest is charged on that resulting total only over the current cycle.
Let me be sure I understand this. You are charging interest now based on debt I carried last month and the month before that.
Precisely. The goal for the bank is to stabilize their funding and account for high fluctuations in borrowing. But the side effect for the consumer is radical volatility in monthly interest payments. Let's use the concrete hypothetical example our source provided to demonstrate the spike.
This is where we need to slow down and listen very closely.
Okay. Imagine 3 consecutive months. In June, you have an average daily balance in ADB of $100. In July, your ADB jumps to $1,000. You made a big purchase. And in August, you pay that $1,000 down quickly, so your ADB is back down to $100.
Okay, makes sense.
Now, in July, when your debt was $1,000, the bank calculates the interest based on the 2-cycle average. So that's June's $100 plus July's $1,000, averaged to $550. Since your actual debt was $1,000, the interest charged in July is only about 55% of what was expected. And the consumer is happy. They feel like they got a break.
But the bank is just deferring the cost. Now, we hit August. I've been fiscally responsible. I've paid down almost all my debt, and my actual ADB is just $100.
Right. But the bank calculates the interest in August based on the average of July, which was $1,000, and August, which is $100. The average is still $550.
Yeah, they charge me interest on $550 even though I only owe $100.
Yes. That means the interest charged to you in August is 550% higher than the expected interest on the $100 you actually borrowed that month.
That is astonishing. I paid down 90% of my debt, but the bank is still charging me interest as if I carried a massive balance into August. It effectively penalizes me for rapidly reducing my spending and debt. Why would any high-value cardholder accept a mechanism that punishes them for paying down debt?
The bank's formal rationale is that it costs them significant opportunity costs to adjust their funding and assets when a customer's borrowed amount varies so wildly month to month. They see it as functioning like a commercial utility charge, where the fee is based on peak usage, protecting them against the volatility the borrower introduces.
So it's a mechanism intended to stabilize the bank's funding risk, but it does so by making the consumer's monthly interest charges wildly unpredictable, and in some cases, punitive right after they've paid down their debt. The actionable takeaway for the listener here is clear. You need to check the Schumer box and verify if you are subject to the average daily balance method or the 2-cycle method.
Absolutely. Caution is key, which is why financial advisors strongly warn against this method. It is most often found on high-limit business cards, where the holder has a dedicated financial team to model and mitigate this kind of volatility.
And just to briefly contrast all this complexity, how does the UK simplify this?
The UK generally employs what's called daily accrual. They simply divide the annual rate by 365 to get a daily rate, multiply that by the daily balance, and bill the total monthly. And while there are minor theoretical differences based on the exact number of days in a month over the course of the year, it is mathematically very similar to the average daily balance method. It makes the calculation much more transparent and simpler for the consumer.
Moving from the math of cost to the control of access. Credit limits. This is the maximum line of debt extended by a lender. Why is this specific number, the limit, such a gatekeeper to financial access?
Because of its relationship to your credit score, specifically the concept of credit utilization.
Which is a percentage of your available credit that you are currently using.
That's right, and its influence is massive. Credit utilization accounts for about 30% of FICO and Vantage score models. That makes it the second most important factor right after payment history. To maintain an excellent score, you have to keep your utilization low, preferably under 10%, definitely below 30%.
So if your limit is low, Even a moderate purchase can push your utilization dangerously high, damaging your score immediately.
Instantly, a maxed out line, one that hits or exceeds the limit, immediately signals high risk, preventing further use. We should remember that historically, banks would allow you to exceed the limit and just charge an over-the-limit fee, though the 2009 Credit Card Act significantly curbed that practice in the U.S.
The history of managing these limits is fascinating. Early bank cards, like the 1958 Bank AmeriCard pilot in Fresno.
Right, they use static preset limits, usually small, modest amounts like $300 to $500, that didn't change unless you called the bank.
The era of mass plastic in the 1960s, especially the mass mailings of unsolicited cards, spurred the first major regulatory intervention.
Yes, the 1968 Truth in Lending Act amendments started to address that, but technological modernization really took off in the late 1980s. Real-time transaction data, coupled with the nascent credit bureau scoring, allowed issuers to move away from rigid limits and dynamically adjust them based on real-time risk assessment.
The ultimate regulatory shift in the U.S. came after the 2008 financial crisis with the 2009 Credit Card Act. This was a pivotal moment in consumer finance.
It was. This law established a core principle, the ability to pay test. U.S. card issuers are now legally required to verify the borrower's income, their existing debt obligations, and their capacity to comfortably afford the minimum monthly payment. That's before they can open a new line or unilaterally raise an existing one. It was a critical move to stop the predatory practice of extending credit far beyond a consumer's means.
Let's look at the current data on the distribution of these limits, because it shows how tightly access is segmented by credit risk, even within this regulated environment.
The U.S. consumer card limit pool surpassed $5 trillion in 2022. It's a vast amount of potential debt. But when you look at the averages by credit tier, the segmentation is intense. For a super prime borrower, someone with an 800-plus FICO score, the average credit line on a general-purpose card was $12,529.
And for the other end, the deep subprime borrower, 579 FICO or lower.
Their average limit was just $1,521. We're talking about an almost tenfold difference in available purchasing power based purely on historical repayment risk. The median limit for all cardholders is around $5,000, while the top 10% enjoy limits near $20,000. Risk model translates directly into purchasing capacity.
The U.S. manages risk through dynamic scores and the ability to pay test, but globally, many countries prefer a more restrained, hard-capped approach to credit extension.
Absolutely. The global context shows really distinct regulatory philosophies. In Europe, cash is still king. 52% of point-of-sale transactions in the euro area are cash, and debit cards are 32%. Credit cards remain a niche instrument, only 6% of transactions in Germany, for example.
So does the EU impose a hard cap on credit limits across the bloc?
The EU's Consumer Credit Directive requires rigorous creditworthiness assessment and fee ceilings, but it does not cap card lines universally. However, certain regional markets do impose restraint. Nordic markets, for instance, cap mass market cards between SEK 100,000 and 150,000.
But the most prescriptive and fixed regulation comes from Asia, particularly Singapore.
That's right. The Monetary Authority of Singapore regulations impose permanent numeric caps based explicitly on income. For most cardholders earning between 30,000 and 120,000 Singapore dollars annually, their total credit line is legally limited to no more than 4 times their monthly income.
That is a direct mathematical boundary set by a regulator. This is the absolute maximum debt you can legally acquire through plastic. It's a fundamental difference from the U.S. model, which allows theoretically unlimited debt if your score and income can support it.
And in India, the Reserve Bank requires issuers to get explicit customer consent before any limit increase, and they must reevaluate repayment capacity every single time. The global approach is definitely not uniform. It ranges from dynamic U.S. risk modeling to fixed income-based global caps.
One final point on the global scale before we move on, the sheer volume of alternative payment methods.
IMF data from 2023 shows that while advanced economies average about 1.5 credit cards per adult, debit cards now outnumber credit cards worldwide. And that's driven heavily by emerging markets in Asia and Africa. The global default payment instrument is shifting toward the debit card. It reserves credit for a specific, often higher risk or higher convenience niche.
We've established that banks generate profit through interest, dictated by risk, and merchant transaction fees. Now let's talk about the third significant revenue pillar, fees and penalties.
These fees are crucial for the bank's stability. For a typical UK issuer, our sources note that about 10% of their cardholder-generated income comes directly from default fees, things like late fees or over-limit fees. It's a huge, reliable revenue stream.
That 10% takes us directly into the sociological debate about late fees. They are often intensely criticized as a systemic penalty against the economically vulnerable.
The criticism is sound. If you are financially insecure, you are more likely to miss a deadline and incur a late fee. That fee then consumes funds that would have gone toward paying the principal, making it harder to pay on time the next month. You are forced to pay higher fees for the same service, which critics argue creates a vicious debt spiral that monetizes poverty.
It functions as an economic barrier. However, our sources also presented an interesting counterpoint, noting that freelancers sometimes levy late fees.
Yes. For a freelancer or a small business, a late fee is a necessary defensive mechanism. It ensures prompt payment and maintains cash flow stability. It protects the provider, who has limited reserves, against income instability caused by slow-paying clients. In that context, the fee is justified not as profit maximization, but as income protection.
To really understand the philosophical role of penalties in society, let's look at the fascinating analogy our sources provided: the library fine.
Library fines, or overdue fees, have deep historical roots dating back to the late 1800s. They were originally conceived as a simple enforcement mechanism to ensure timely returns so that limited shared resources, the books, could be used by others. The Aberdeen Free Library in 1886 fined borrowers a single penny a week.
That fee was primarily a behavioral modifier and a way to recover administrative costs, not a major revenue stream.
Exactly. However, in recent years, there has been a powerful elimination movement, driven significantly by the American Library Association, the ALA. The ALA passed a resolution arguing that monetary library fines constitute a form of social inequity.
The argument being that the fine is an economic barrier that keeps vulnerable populations, particularly children from low-income families, from accessing vital library materials.
It runs counter to the library's mission of universal access. This movement has led to creative alternatives, things like food for fines programs or allowing children to read down their fines by dedicating time to reading at the library. Many major urban library systems realized during pandemic suspensions that the administrative cost of chasing small fines outweighed the meager revenue gained, and they went permanently fine-free.
That's a powerful analogy. The banking late fee is essentially an economic barrier to financial access and stability, much like the library fine is a barrier to knowledge access.
And it highlights the philosophical debate.
Mm-hmm.
While fees can be legally enforced, though aggressive punitive measures are typically reserved for recovering stolen property, not just an overdue book, the true cost is exclusion and the creation of cycles of debt.
Let's pivot back to specific banking fees. Let's look at two specific risk-based interest rates. First, the cash rate.
This is a separate, almost always higher interest rate charged on cash or quasi-cash transactions. And it's coupled with an upfront cash advance fee of 1 to 5%. This includes getting cash from an ATM, buying casino chips, or loading certain types of prepaid debit cards.
Why the punitive difference compared to a regular purchase APR?
Because the bank receives no merchant transaction fee on these cash transactions. When you use your card at a store, the store pays the bank that 1 to 4%, which subsidizes the risk. Without that subsidy, the bank prices the cost of lending that money higher via the cash rate to cover their cost of capital and their desired profit.
Then there is the deeply feared default rate, or penalty APR.
Historically, this was a contractual rate, often between 10 and 36%, that was triggered by negative events. It could be activated by something as simple as one late payment, charging over the limit, or the deeply controversial doctrine of universal default.
Universal default was the nightmare scenario, right?
It was monstrous. Under universal default, defaulting on a loan or even a utility payment with a completely different company could trigger the maximum penalty rate on your credit card. You could be managing your credit card perfectly, miss one obscure payment somewhere else, and suddenly your card rate quadruples overnight.
Fortunately, the 2009 Credit Card Act addressed this systemic risk, correct?
It did. The act sharply restricted the punitive nature of the default rate. It limited rate increases on past balances only to accounts that have been over 60 days late. This means a single, isolated late payment usually won't trigger the penalty rate on your existing debt, although it might apply to new purchases.
Finally, let's look at how banks use these mechanisms in their marketing to entice users while still maximizing profit. We see the heavy use of promotional interest rates.
These are the eye-catching low or 0% interest offers for a set number of cycles. They're applied to new purchases or balance transfers. They serve as a powerful marketing tool, helping retailers boost sales while giving the bank a chance to acquire new customers and increase overall lending volume.
But these offers are often intentionally complicated to ensure the bank gets its money one way or another.
Oh, absolutely. The complexity centers on payment allocation. These offers often require the cardholder to pay off the promotional balance by a specific deadline to avoid paying all the accrued interest retroactively. And crucially, banks may contractually allocate payments automatically in obscure ways. For example, they might be required to pay off the lowest interest promotional balance before the higher interest existing debt. This ensures the higher interest balance accrues for a longer period, making the loan more expensive overall.
That's classic obfuscation through complexity. The fine print ensures the consumer is unlikely to minimize the overall interest cost.
This complexity, however, gave rise to a clever arbitrage technique called stoozing.
Explain stoozing to our listeners.
Stoozing involves strategically exploiting promotional rates. The consumer borrows money at a 0% promotional interest rate, immediately places the borrowed money into a high-interest savings account or a high-yield CD, earns a profit from the safe interest, and then repays the original 0% debt in full just before the promotional period expires. The stoozer is essentially using the bank's capital, interest-free, to generate passive income, risk-free.
It's a perfect example of a savvy consumer exploiting the bank's marketing mechanism designed to lure in debt-carrying clients.
And finally, the ultimate marketing maneuver that has fundamentally altered global finance: rewards programs. These programs, pioneered by Discover in 1985, are a way of sharing the lucrative merchant transaction fees with the cardholder through points, miles, or cashback.
And these programs have accumulated monumental value globally.
Unbelievable value. Our sources point out that the combined value of these reward points and miles, these shadow currencies owned by consumers, now holds more value worldwide than all U.S. paper dollars in circulation.
Let that statistic sink in for a moment. A privately managed, non-government-backed digital currency created by banks and airlines is worth more than the physical U.S. currency. What are the implications of that scale?
It raises profound questions about bank liability in the economy. First, it shows the incredible profitability of those small transaction fees. I mean, if those points are worth trillions, the fees that fuel them must be exponentially higher. Second, this is an immense off-balance sheet liability for banks and airlines. They constantly have to manage the issuance and redemption of the shadow currency without devaluing it.
And finally, the presence of these massively valuable rewards programs is a distraction. They effectively make comparing competitive interest rates incredibly difficult because you're factoring in the value of miles versus a lower APR. The rewards are designed to obscure the true cost of the loan, which is precisely why they are so effective.
Wow.
We've covered the fundamental structure of plastic money, diving into everything from historical charge accounts to the shocking volatility of interest calculation and the global scale of digital reward currencies.
The biggest takeaway is that plastic money is a world of structural complexity. You need to distinguish between charge cards, which are pay in full, revenue from merchants, dynamic NPSL, and revolving credit, which is pay interest, revenue from balances, fixed limits. That fundamental choice really dictates your financial discipline.
And crucially, we realize that the nominal APR is only the starting point. True financial mastery requires understanding the effective annual rate, the EER, that silent tax of daily compounding, and most critically, identifying the specific interest calculation method your bank employs. If you are subject to the volatile two-cycle average daily balance method, you must be hyper-vigilant about paying down debt rapidly to avoid being penalized for your previous month's spending.
We also saw how access to capital is globally managed, contrasting the U.S. risk-based ability to pay limit system with countries like Singapore, which impose firm, simple, income-based caps, and how the sociological impact of fees from libraries to banks can create systemic barriers to financial equity and access.
So, what does this all mean? It means the power dynamic in consumer lending is determined by your attention to detail. Your nominal APR is only a fraction of the story. Understanding your specific calculation method, keeping that credit utilization factor low, which accounts for nearly a third of your FICO score, and recognizing how those hidden fees and rewards programs are designed to obscure the true cost of borrowing, well, those things are essential to controlling your financial destiny.
And that leads us back to our final provocative thought for you to chew on. If this vast system of rewards points and frequent flyer miles holds more tangible value than all physical U.S. paper currency, how much profit are banks and airlines extracting from the small, seemingly harmless transaction fees that fuel this economy? If convenience and loyalty are generating a shadow currency worth trillions, how much are you really paying for the privilege of swiping plastic?
Something to consider the next time you decide to book a flight with points. That was the deep dive.